they can check out on my YouTube channel, Dev's Cox Property and Finances. So that's where we post these sessions. So this is I think this is the fourth dinner that we're having. Last week was amazing, on fire. We had Oz Remu was talking about the wealth protection. So it was the wealth protection dinner. We're taking everything from trusts to wills, and it was absolutely incredible. So please go and check it out on my YouTube channel if you missed it. But because of amazing response that we got, we're going to run another session next week. So we're going to have another dinner next week, just to pick up where we left off. And if you have any questions, please make sure that you send those questions. So the dinner will revolve around the questions that we're going to be getting. Whether you need to maybe in community of property or out of community of property, what are the pros and cons for that? So all those we'll be discussing there. So please make sure that you don't miss out. And just to also remind you that the book is available. Amazing, hot book, Financial Planning for What? Talking about black tax, talking about debt consolidation, debt cancelling, talking about the power of stokvels, property investing, everything that you need in this book. You definitely need to have one. Please hit me up, 074 412 7614, at your copy, and it will be delivered to you. Now, let's get into it. So I'm so super excited. I think, since I reached out to Tim, I haven't really slept. I was just so amazed in terms of what he's doing, and to be able to come to this platform and share his expertise is absolutely incredible. Good evening, Tim. How are you doing?
I'm very well, Gavin. Thanks for having me on, and I'm looking forward to having a conversation with everybody this evening.
Thank you so much. Now, before we get into the swing of things, Tim, please introduce yourself. Who are you? What do you do? And so that we can just get started.
Sure. My name is Tim Akinnusi. I am the founder and chief executive of a fintech platform called mortgagemarket.co.za. We are a marketplace for home loans. We enable customers to get access to all of the banks with a single application. And we have this amazing product that actually then pays customers up to 25,000 Rand back when they get their home loan with us. The simple idea behind that is that we are displacing the brokers, and we're giving customers the fee that the brokers traditionally would get. We were actually giving customers that fee back as a result of that. So that's who I am. Just a bit of background. I've been in financial services for north of 15 years, and 10 of that has been spent within the home loans environment. I used to be the executive head of sales and client value management at Nedbank, and I was also the managing director of ABSA's home loan business prior to me switching over from corporate into the world of entrepreneurship.
Yeah, wonderful. Yeah. How has that been? When you jump,
Look, it's scary as it is, just making that shift from a steady income and a great source of support and that corporate sort of shell that that I've been cocooned in for a while. So that wasn't easy. And of course, when you step into the world of entrepreneurship, you're pretty much on your own. Everything lives and dies by your actions. And it can be even more complex when you have the market sort of being affected by COVID the way it's been affected.
Yeah.
It's not an easy journey, but it has been rewarding in ways that I never thought it could be rewarding.
Yeah.
Which makes it the journey worthwhile. So yeah.
Yeah. Fantastic. No, you're still fantastic. Now, I mean, I normally start these dinners with a simple question, because I think it drives on the back of what we're trying to achieve, you know, talking about wealth creation, talking about generational wealth. According to you, you know, if you had to now define what wealth creation and generational wealth is all about, how would you define it from your perspective?
Yeah, I suppose one of the definitions I could apply to it is this concept of abundance, right? And, you know, because wealth is not just financial, it's also about your health. It's about the love that you're surrounded with. It's about the friendships you have, you know. So regardless of what context, you will always know that wealth is about abundance. You know, wealth is about just being connected to the source of whatever it is that you are choosing to feel wealthy about, you know.
Yeah.
You know, to give a simple example, if you were to win the lottery today, I don't care how much that amount is, it is not wealth. It is not wealth simply because you are not connected to the source of it, you know. So whatever it is that you get is finite, and it's finite and diminishing.
Yeah.
Versus wealth creation is, or wealth in its very definition is abundance. It's infinite. It's ongoing. It's ongoing.
Yeah.
And I think it's an important definition to make. And this is why, you know, so many experiments around the world have. Somebody's saying they can't hear me.
I think those who can't hear, because we get that a lot, it might be that please check if maybe you need to put in your earphones, or maybe if you're on your earphones, then you just take them off. Because if everybody else can hear, then probably the problem would be with you. Yeah, so try that. I think it's Siwelile. Yeah, so please, if you can do that, it will be greatly appreciated. All right.
Okay, great.
Yeah, cool.
Yeah, so basically, and look, tons of experiments have been conducted around the world, right? About this idea that, you know, you give an individual that is potentially financially destitute, you know, and you give them a lot of money, and you take somebody who has means and you strip away all of those means. Yeah. And a couple of years later, the individual that had means, that had access to wealth, is wealthy again, and the individual that had a lot of money is back to square one. And that just is a classic definition of what wealth is. It's an endless source of where things come from. Yeah. And yeah, I think it's something that we all try to strive for. You know, the most interesting story that I heard the other day, as I was sort of preparing for this chat, was an experiment that was done when I was in San Francisco. I visited a university called Singularity University, and they were talking about this concept of exponential thinking. And I'd like to actually know, I don't know if you're able to run a poll, but if you were given R1 million today versus 1 cent that doubled every day for 30 days, which one would you choose? I'd love to see what the responses are, perhaps later on, and I'll explain the concept of which one is actually the better trade-off.
Powerful, right? So, I mean, then Tim, you've been in the home loan industry space for a while now. When it comes to, I think let's start from the process of the applications. What are the mistakes that you have picked up that, you know, a lot of people are making when they apply for a bond?
So, you know, obviously the process itself, right, is not a very complex one. As much as it can be quite daunting and you know, one that invokes a lot of anxiety. I think the anxiety comes in is just having to face up to your understanding of how much you actually earn, how much your expenses are, and what is required of you to acquire that property, right? So I think a lot of the times the biggest mistakes that people make is not understanding the key components of what goes into this 20 to 30 year journey that you're about to take with the bank. So, you know, the giving of your personal information is easy, right? The giving of your income is easy because you know it. You know how much you earn, you know what your expenses are. The giving of your employment details and your banking details, all of that is easy. But the most important thing is actually before then, is the preparation before then, is understanding your relationship with credit. Is understanding and coming to terms with the fact that the bank, before they say to you, we can even give you X amount of money, what they want to assess is, are you good enough to be trusted with money that you can repay back over a very long period of time? We're talking about a period of 20 to 30 years. So that's what the bank is trying to assess. So the mistake that people make is not even at that point, but it's all the incidents before that and how they related with credit in the past. And that's where the reckoning comes from, is having to now have to face up to some of those things. You know, it can be quite daunting for an individual. So it really is. It starts with understanding this concept of a credit score, which, by the way, is the second most important number that you will ever have to understand and know outside of your ID, is your credit score, right? And your credit score is really a combination of how you have related with credit over a long period of time. So things as small as your credit cards, an Edgar's account, a Jet account, a cell phone bill, you know, those sort of things is what gives the bank an indication of whether or not you have been consistent or you are consistent with repaying. The moment you are, that is significant currency, and all banks would want to deal with you, right? And they'll obviously deal with you in accordance to your earnings in terms of how much you can actually afford. But that gives you the key to get into that space.
So I mean, I like what you say, but somebody can be sitting there and says, look, Tim, you know, things happen. I lost my job. I mean, I remember when I jumped the first time, and you know, I felt that I was like a convicted somebody, because now to get into the system again, it was a problem. And coming from a basis where you had a business that failed, now you had all these debts that you needed to pay. Then you pay the debts. Then all of a sudden you don't have the debts. Then you want to apply. Then it becomes a problem. So in that case, then when somebody maybe is under debt review, that now they're out of the debt review, you know, what should they be doing to make sure that now they can go and be able to now apply for the bond? You know, what is that process like?
Right. So it's an important point you raise to say, you know, how do you remedy it? You know, so it's one thing that you've now got yourself in a position where you've either, through no fault of your own, or through misfortune, you've lost your income and you can't make repayments on your debt. I'd like to talk about that before then moving on to how you remedy the entire situation. I think the first thing is for anyone who is currently faced with a debt obligation that they aren't able to pay. The easy thing and the knee-jerk reaction thing is to bury your head in the sand and to run from that, or to not pick up the bank's phone call, or to ignore the messages and emails, etc., etc. That actually is counterproductive. It's the worst thing you can ever do, because they will continue to take further action that will continue to further put the nail in the coffin in as far as that issue is concerned, and actually destroy the one thing that you have that is tied to your wealth creation, actually, which is your credit score, right? Because once they destroy that, the road to recovering that is a long road, and often leaves you in a position where you have to continue to prove that you have rehabilitated and that you have reformed. So the first thing to do is to never run from that. Rather do the difficult thing as to say, I can't afford this car anymore, or I can't afford this house anymore. The banks themselves are obligated to step in and assist you in whichever way you can, right? Either if it's through giving you concessions on how to sell the house, or concessions on the debt that is owed, or making it easier for the next person to buy the place. They will make concessions, because the reality is that they actually lose money when a house goes into foreclosure as a result of a debt that is owed. They actually, because they will recover their full money on that debt. So they too don't want it to go there, right? They also don't want it to get to that level of severity. So that's the one thing in terms of the prevention. Now, when you have found yourself in that position and you want to remedy it, it's the same process again. Whatever credit commitments you have is to make good on them. Okay. If you have, say, for example, missed a number of payments on a credit card or a cell phone bill or whatever it is, make good on that repayment and compel your creditors to write a letter that exonerates you and says you have met all your debt obligations and that you have paid it up in full, right? They write that letter, and that letter becomes your evidence to be able to get back into the credit market to access credit again. So even if you may, like we have a platform that allows people to apply for pre-approvals, and their credit score is good, we still ask them the question to say, did you default in the past? Because if you defaulted in the past, some banks might have a much more longer history in their consideration for your future credit. So as long as you can prove that yes, you did default and you've remedied the situation, and you can show proof of a letter that's been paid up, the banks will always be in a position to overturn that decision and to consider that, because they are only looking at the black and white. They're only looking at the numbers. So, you need to meet them at that same point by providing with evidence at a quantitative level that you have paid up your debt. And then you'll be back into the entire credit system.
So now you're saying that not all banks work the same. Is that maybe what we're trying to get at, that some of the banks will look at maybe differently to another bank when it comes to now that assessment?
So by and large, the methodology of how they assess your credit is largely the same. That hardly changes. So the principles are the same. Certain banks will choose to look at your credit history over a longer period of time. Others maybe over a shorter period of time, depending on what their credit appetite is and what their credit policy allows them to do. So each bank's credit policy is unique to that bank's appetite. Like, I can tell you, if you see a much larger bank, like say Standard Bank, because of the nature of their size, their credit policy tends to be a lot more widespread. So they're a lot more accommodating because of the size of them, right? Versus a smaller bank that, may not be in a position to take the same exposure and risk as a Standard Bank. So their credit policy will be different, to that the bank.
Okay. And then Tim, then when it comes to the term of the bond, there's always this concern around whether do I take 20 years or do I take 30 years? What is the difference? I mean, if I'm new into this, I want to apply for this home loan, and now I'm faced to answer just, okay, do you take 20 years or do you take 30 years? What is the difference?
So quite simply, the difference there is the amount of interest you pay on the loan. And it's a trade-off again. So if you take 20 years, right, you will pay the least amount of interest on a contractual loan, because the home loan agreements they go 20, 25, and 30 years, right? So there are pros and cons to it. At 20 years, you probably be repaying on a monthly basis a much higher installment, because there's less time for you to repay the bond. So they want more from you over the months, versus a 30-year where your repayment is a lot lower, but you will end up paying a lot more interest over the life of the bond. And the difference between the 20 and the 30 is another 10 years worth of interest charges that the bank will charge you on.
Yeah.
My suggestion is always never start off at the hilt of 30.
Okay.
And the reason I say that is that a lot can happen even in 1 year, 6 months, right? Yet alone 30 years. So you want to be able to take 20, because at 20, you give yourself the opportunity to restructure the loan in case you get into financial difficulty and you need to lower the repayment from what it currently is at 20.
Yeah.
So you allow yourself the opportunity to restructure your loan, and that's always a really good sort of tool to have in your toolkit, because we're all going to go through financial difficulty. We're all going to go through bumps in the road. So it's just a little bit of a protection there.
Yeah.
I'd like to actually compare that to the car industry. So the motor industry, which at times can be quite predatory, all they're trying to do is to lower the repayment that an individual would be allowed to repay on the monthly installment of the car. Yeah. So they will always start you off at the highest level, which is, it's very terrible to see individuals, buy cars that are financed at 7 years, which is the maximum. 7 years, 40% balloon payment. I mean, it means if you get into financial difficulty, there is no wiggle room. There's no extension to lower your repayment because you're already at 7 years. Yeah. So the only choice there is for the banks who finance the loan to actually come and repossess that car. Yeah. And where I believe home loans should be a lot different, because home loans is naturally it's more of an asset base than a depreciating sort of consumption product. Okay, fantastic. Now I want to pick up then on the restructuring part of things. I mean, refinancing comes to mind, when you talk about restructuring. And, I get a lot of people asking me, what is refinancing? How does it work? And I think it's one of those things that I get on a weekly basis, where people ask me about refinancing. From you, right? I mean, you're the expert. What is refinancing? How does that work? So financing is simply, I have a house that's worth R1 million, and I want to finance it using the bank's credit. Yeah. So you finance it, they give you R1 million. Refinancing is saying, I have now paid off, say, 500,000 of that bond. Now I want to take it back to the curve where I started off. Yeah. So you want to take it back to R1 million. So you want to access a further 500,000, which is what financing is. Yeah. A further loan, which is also another term, is I bought a house for R1 million 5 years ago. It's appreciated in value, and I want to access some of that value. So I bought it for 1 million. It's now worth 1.5 million. Now I want to access the 500,000. So I take out a further loan to access that. Yeah. So that's why homes and property is such a great store of value, because it allows you to continue to borrow against the future appreciation of the asset, or at least borrow against the portion of the loan that you have paid down. Okay. You can always access it very cheaply, as a using your credit card and overdraft, because you'll be financed. Right now, home loans are financed at about 7%. Which is the lowest and the cheapest form of debt at the moment. Definitely. Now, when it comes to, I mean, there's a lot of people that are in the townships. They into property investing, and within the township space, you have a house, then you put in like 5 rooms,
within that yard. How easy it or how difficult is it from one to then refinance on that basis? Is it something that the banks are looking at, or is it difficult on that aspect?
Yeah, it's such an important thing because if you look at the rules at how banks choose to secure a loan, they secure it against a property. Now, the property in itself, and I always say this, property in itself, or the house, the bricks and mortar, does not necessarily have value, right? The value comes from the predictability of what the next buyer can buy.
All right.
And that predictability comes from having a standard of how you value the house, even the next house next to it, et cetera, et cetera. So that's why you find that, when banks come to value homes, they value the house not on the house itself. They look at comparable sales around the area to say, what has the next house that has the same size sold for, right? What keeps that value very stable. It's also the same reason why a lot of high-end homes that are spec'd, that are not the same as the next house, like, for example, a 15 million rand house is not necessarily the same as the next house next door. It's usually very different. So banks find it very hard to value that house because there is no comparative to it, right?
Yeah.
So if you look at a situation where a house is in a township environment, right, the most important things that the bank wants to know if they want to give you financing against that house is, can it be sold, and can they predict or get to an agreed valuation?
Okay.
So the only way they do that is by having similar houses of a similar quality and structure around it. And this is why it's important that, just with the house itself, it needs to be in a position where there are other houses of similar value around it.
Okay. All right.
Because it's difficult for a bank to be able to loan against it if they don't think that the money that they've loaned you, they can recover it. Next buyer comes along and says, I don't think it's worth what was paid for.
All right, fantastic. Now I want to go back a little bit because I want to take a question from Pascal, who says, in regards to understanding our credit score, is a score of 686 regarded as a good or bad?
So typically it would be regarded as good, but you must also understand where those credit scores come from. They're different. So different credit bureaus have different credit scores. We work with Experian. So when we do a pre-approval for a customer to give them an instant bond, we use Experian's data. And so their data would go from, let's say, 604, which is poor, 604 to 618 is poor, 619 to 630 is good, 630 to 640 is very good, and then 640 above that is excellent. Okay. So typically a score like that would be excellent, but it's important to also understand the grading behind those scores.
All right.
Those scores need to come with a particular grading.
Yeah.
So different have different ones, which I can't really speak on, but I can speak on the one that we actually use, which is Experience. Yeah.
All right. Okay. Fantastic. Now, interest rates are very low, right? 7% lowest in a long time. Now, a lot of people now say, look, this is my chance to fix my interest rate. Is that possible now? Is it wise? How would you advise somebody who's sitting now and say, look, I want to go and fix this interest rate,
Yeah. So the simple answer is this, is that fixing your interest rate is not as straightforward as fixing it at 7. When the banks any bank fixes an interest rate, they fix it at a premium.
All right.
So you can never, ever fix your rates. Right now, interest rates are prime, which is 7%.
Yeah.
Nobody in the industry ever fixes a rate at 7%. They add a premium to that of about 2%. So you'll be fixing at 9%, right? Which means that you'll be paying more interest on the same loan. So why I never advise for customers to fix the rate, because that is like crystal ball stuff. The only time you fix a rate is if you believe that the premium that you pay is going to pay off because interest rates are going to go beyond that premium. Okay. So, i.e., you should literally know or have some kind of forecast, which nobody has, that tells you that interest rates are going to go beyond 9% and continue to climb indefinitely. All right. And when you fix your rate, you can never really fix it for the entire loan of the entire duration of the loan. Yeah. They only allow you to fix it for, like, say, 5 to 10 years. Okay. So that brings another complexity because you only enjoy the fixed rate for a 5 to 10 year period. Oh, okay. The advice right now is take the low interest rate, let it float, be in a position where you pay the cheapest amount of debt, and interest rates are not going to shoot up anytime soon. A lot of customers have asked us to say, okay, well, Tim, you're telling me to buy now, but what if interest rates start climbing back up again after COVID? Yeah. That's not going to happen anytime soon. Yeah. COVID is just the tip of the iceberg because the economy is in a recession. It's in its absolute doldrum. And that would mean that it's going to take at least another 2 to 3 years for the economy to recover. And in that time, the Reserve Bank has to keep the economy stimulated, and lower interest rates is one way of stimulating investment, spending, et cetera, in this time. Okay.
And maybe, Tim, just to maybe ask with regards to that, is there a relationship between the interest rates and inflation? Somehow, is there some sort of a relationship there?
Absolutely, yeah. Because inflationary pressures is something that we're going to face very soon, right? So typically when there is too much spending, right, prices are going to rise. And that rising of prices is what causes the Reserve Bank to want to increase the interest rates to slow down the spending, right? To say it's better to save, so we'll actually make it more favorable for people to save. Yeah. But when consumer spending, so that's why they always talk about this target range of the consumer price in inflation, which is basically to say, is there too much spending? Is there too much money being produced? Because that too much means that the value of the currency is not stable, and that's what produces this devaluing of the currency, because it's no longer as a strong store of value. Yeah. So there is a correlation that's quite direct between interest rates and inflation. So you'll see now inflation is incredibly low because the spending of people has just been incredibly low. Yeah.
Okay. So I know that maybe this question is not really too linked to you, but I mean you're in that space. So Nombulelo is asking, can you guys differentiate between transfer fees and transfer duty?
Yeah, sure. So transfer duties, it's actually one of the things that we do because we work with a lot of attorneys. Yeah. We have a panel of attorneys that give a 50% discount on transfer cost when you do a bond. Yeah. So the transfer duty is the tax that you pay to the government, right? Now, from a property standpoint, that tax is now over R1 million. So if you buy property that is, say, $1,100,000, you only pay transfer duties on the 100,000 and not the R1 million. Yeah. The transfer fee is the fee that you pay to the attorney to transfer that amount transfer that property into your name. Okay. So the attorneys will charge that fee, and that's the difference between the duty and the fee. Yeah. And then of course it doesn't end because there's an attorney on the other side who does the registration. So you then pay a registration fee for them to register the property into your.
Okay. Yeah. And Tim, I mean, there's been a lot of I think a lot of people have been asking about this subsidy thing. The government is running. How does it work? The subsidy, is it there? can a person apply for it? And what is the criteria for that?
Right. So the government does have a housing subsidy. I think the most popular one is called FLISP, which is a finance-linked subsidy. I forget the full name of it now, but it works on a sliding scale. So the less that you earn, I think it's an income category of, I think, 22,500 Rand as a household income. You can apply for that subsidy along with your bond as well. Okay. So the subsidy, so the less you earn, the bigger the subsidy amount that gets given to you. Yeah. And you can use that to either pay transfer fees or to actually put directly into the bond. And actually, all of the departments work with all the banks to be able to facilitate the payment of that subsidy into your bond as well.
Yeah.
Yeah. Okay. So, and of course, typically it's for individuals that are previously disadvantaged who do need that financial support, either for the deposit or to pay, other costs associated with the bond.
Fantastic. And have you guys, gotten applications for such, and how did it go?
Yeah, we have. We've got customers that apply online to us, which is great because they find out how much they can afford, and they can also find out if they can afford even more with the subsidy that gets put in place. Yeah. And we project now with the UKZN government, where basically, when you've done a pre-approval and you know how much you can afford on a particular place, we start to actually send them all of your information for them to make the application for your FLISP. And then by the time it gets to the banks through us, the banks already know that you've been guaranteed a FLISP product linked to the home loan that they're able to give to you. Yeah.
Okay. And then maybe just before I go to the questions again, in terms of then for one who doesn't have the transfer cost or the bond cost, can that be factored into the bond that I'm trying to apply for?
Yes, it can. We have some of our banking partners offer 105% bond, and some offer even like SA Home Loans with us offer a transfer assist product as well, which they help with the cost of it. But typically, I would always say, going into a transaction like buying a home, please never believe anyone that tells you you need no money to buy a house. You do need some money. Let's be honest. There are costs that you can't void completely, and the bond payment is not the only cost that you have to contend with. There is rates and taxes, there's levies to be paid if you're in a sectional title, there's maintenance cost, because if you want this property to appreciate in value over time, you have to maintain.
Okay, fantastic. So I'll go to the questions. Just to remind everybody, please send us your questions. We will take them through as we go along. So I'll take a question from Stembiso. Says, what will your advice be if I want to buy a second property while I have a current bond running on my primary property? Should one apply for refinance to finance the second home, or buy the second property and consolidate the two bonds?
Okay, I'll try and walk this through. So basically, you have an existing house that you're living in, and you want to buy a second house for investment purposes, right? Yeah. I think the first thing that you would need to just ensure is that you can afford to pay both bonds, because then the bank is going to look at your current bond obligation, and then they will look at what else is left in your income to be able to meet second bond obligation. One way of offsetting that or of motivating to the bank is by actually having a lease agreement in place that says, for example, I've got a R1 million bond today. I'm looking to acquire another property for R1 million, and I'm going to rent out that property. Here is the lease agreement that says I'm renting out that property for 8,000 Rand a month. What the bank will then do is they will add that 8,000 to your affordability and consider at least 60 to 70% of the 8,000 money that you don't have to be accounted for, basically.
All right.
Yeah, and then they will then give you a second bond over that. So it's a great way to leverage the bank's money. Is, you know, we are on a topic about wealth creation.
Yeah.
You've got to be able to leverage the bank's money. And the way to leverage the bank's money and get access to more of it is by having a really good credit profile.
Yeah.
That's the first thing the banks are going to look at. And, you know, once you have a good credit profile, they are likely to open up their coffers to be able to fund you and fund the debt you're looking to acquire.
Cool. Now, there's something that I really need to understand, right? So when you go to the bank and apply for the bond in a company, right? So let's say this company is still new, no financials, and then the bank looks at me for the assessment. Now, how is it when I go via my personal capacity that I might then get 100%, but the loan to value when it comes to the company might be less, but yet the process is the same? Or is it the same?
Yeah. It's a good question, and it really shouldn't be much of a difference, because the only difference there is that the registration details that are going in are the company's details versus your own, because you as a company director, you're still standing surety to pay that place. They are going to defer to your income to pay the place.
Yeah.
The only that might be different is maybe if the property is at a particular amount, say a 4 million rand property, then it automatically will trigger a 15 to 20% deposit.
Yeah.
Right, because of the size of the home loan.
Yeah.
But typically, whether or not you're registering it in a company's name or in your name, the outcome from a credit standpoint should still be the same, because you are the one standing surety for it.
Yeah. Okay. All right. And when it comes then to a joint bond, is it the process where, from a qualifying point of view, do they take, maybe if the bond, to qualify for the bond, maybe I need 30,000 as a gross income. Do they take half from each one if there's two people applying for that joint bond? How is that process like from a credit valuation point of view?
Yeah, so the same, and they will look at both of your expenses combined.
Yeah. Okay.
And whatever the surplus is what poor credit profile, your entire loan could actually be declined, right?
Okay.
Because bank is not putting weight in on just the one person. It's putting weight in joint bond. And, you know, we've had quite a few incidences, you know, in our process where couples are married in community of property, and, you know, one of them's credit profile has not been conducted well. The bank will still see you as one. And that's quite important to note.
So just to touch on that, because that one is controversial. So now, I mean, there's people that are sitting there as like, dude, I'm married in community of property, right? And this dude doesn't want to buy a property. I want to buy one. Now, is there a way out in that process? Can one apply for a bond where the other one, he doesn't want to, but they're married in community of property?
Unfortunately, you know, it's also about understanding the principle of married in community of property, is that you're taking a vow, you know, and I don't want to get preachy here about relationships. In essence, you have taken a vow to do things jointly, to be jointly accountable for each other. And on that basis, that everything else flows from there. It's on that basis that, you know, you can't sign for something without your partner's consent, especially if they are going to be held liable to make repayment on that thing. You know, they would need to be in a position where you know, they are consenting to that. You know, that's really the spirit behind in community of property.
Yeah. No, I think that one just needs its own dinner. You know, we're gonna. All right. I'm gonna take a question from Lise. So Lise says, in the buying process, when or slash at what point is the deposit paid over to the estate agent or the attorneys? And when do you pay over the transfer fees and the transfer duty?
Okay, so typically the deposit is not paid over to the estate agent. It's paid over to the transferring attorneys, who keep that money in an escrower account. So basically, it's an independent account that that at least ensures both parties that the money is kept safe. Yeah. And that would typically happen, after the offer to purchase has been signed, maybe within 10 to 15 days, depending on what's been negotiated. Yeah. And then, of course, you then have 30 days to go away and find a bond over the house, which you would indicate to the bank that you've paid in a deposit on there. Okay. What was the second question? The second part of the question?
It was, and when do you pay over the transfer fees and the transfer duty?
Right. Those are paid after the bond has been secured. So when you've decided to take a bond through a bank, what they will then do is then they will initiate or instruct an attorney to contact you and sign the paperwork. Yeah. And on both sides, you'll be contacted by the transferring attorney as well as the registering attorneys to sign. Okay. And upon then that they would then, they would have actually presented you with an indication of the fees that you're going to be liable for. So yeah, and those fees are fairly standard.
Yeah. So we're almost at the end of our dinner, but I'm gonna take one more question before I give you a task. So I'm gonna take a question from Utando. Says, what are the implications of moving a bond from one bank to the other within 4 years? Okay, jumped. Okay, let me just, where's that? Okay. To the other within 4 years, if I feel that the interest rate that I'm paying is higher than the other bank.
Okay, so the implication would be, and which it happens not as frequently, but it is something that happens. So bonds being transferred, you will be liable to pay a transfer fee, because there will be an attorney that would need to facilitate that transfer. Yeah. But what you would be giving yourself is an opportunity to finance the same debt at a much lower interest rate, which is why people often move. Yeah. But that only happens when, like, your initial interest rate is extremely high, such that that by switching your bond, it will drop your repayments, materially, to make it worthwhile for you to pay the cost of that transfer duty. Yeah. Yeah. Some banks do assist with that whenever they run campaigns. Yeah. If they're looking to get new people that already have bonds transferred over to them, they sometimes will help out with the transfer cost. Yeah. But the most important thing is that if you move over, you should be in a much better position than you were in your previous institution.
All right, fantastic, fantastic. So as a tradition in this house, we're gonna give you 3 scenarios, and please give us your take on those ones, right? So now you have 3 groups of people. So you have somebody who's in the early 20s, you have somebody in the early 30s, and you have somebody in the early 60s, right? So now from the early 20s, what advice would you give that person around, property and applying for a bond? What will be, that advice? What should they be doing, especially around wealth creation? What should they be thinking? What should they be doing? The same as somebody's in their 30s, maybe they're married and, maybe they don't have a house or something like that, but what advice would you give them? And somebody who's in their 60s and say, look, I'm here, can they still apply for a bond? What would you advise? So yeah, so those 3 groups of people, and provide us with just your advice for them.
Okay, so I'm in my 30s, so I have some perspective around the first 2 groups. So yeah. I'll give it a shot. Around the group in your 20s, if you're looking to create wealth, get into property immediately. The biggest mistake that a lot of people make, I don't care how educated you are, or how ill-informed or well-informed you are, is that people make this mistake of buying cars and financing cars before they finance the house. Now, what happens is that because your car installment is there, it already soaks up a lot of your income, and it prevents you from being able to afford the house, which is why you don't find a lot of people owning property in their 20s. So if you do have that opportunity to start early, get yourself at least a 1-bedroom, something that's fairly standard, that you know you can rent out, and that you know that will take you at least 5 to 6 years into the next phase of your life, where you find a partner, you want to settle down, you want to have a family, etc., etc. Right? Then you can use that as a nice nest egg to start off on your property journey. So I would say try and get into property. It's never too early to get into property. You'll never lose, because they're not making any more land. So you need to take up what is currently available. I made that mistake. When I was in my 20s, there was a property in Sunny Hill that was going for 300,000 at that stage. I decided to go out partying on the Friday. I missed the show day on the Saturday and went to the Sunday show day. I got to the Sunday show day. Those first, first phase was sold out.
Yeah.
The next was at 350,000. And because I had this lovely Audi, I literally lost out on being able to get into that second phase.
Yeah.
So to the guys in the 30s, when you buy property, buy for the long term. Be very clear on the purpose. Be in a position where you know if your life state is going to change. So, don't buy to flip in 1 year or 2 years. Buy to hold for at least 5 to 10 years, so that the property can appreciate and you can have some upside, and you haven't made some payments to reduce the debt. Okay. And then to the last group, if you're in your 60s, unfortunately, there is a cutoff where banks will stop financing you, and it's linked to the employment age of 60, because that would be considered reckless lending, as typically as an adult, beyond 60, you're not expected to be as economically active as you were in your 20s and in your 30s. Yeah. So I would say at that stage, you potentially want to be renting a place, so that you have funds to enjoy your retirement.
Okay, fantastic. Now, wow, I think a lot of us have really learned a lot on this session. I definitely do. Please give us your details, Tim, in terms of how do people find you, so that they can be able to make use of your services.
Sure. The easiest is to go onto our website. It's literally mortgagemarket.co.za, or they can find us on Facebook at Mortgage Market SA, Instagram at mortgage.market, and LinkedIn Mortgage Market. Yeah. So that's the best way to find us. Yes. You can email us, contact us via WhatsApp, and we typically have one of our consultants that's able to assist you at any point in time. We are not banks, so we speak to you in a normal language. We simplify everything, and we basically will guide you through the process of getting the best deal on a home loan. Yeah. And of course, it's just a pleasure to be able to pay customers back money just for capturing their own applications with us.
Okay, fantastic. Now, on that note, I don't know what to say. So thank you so much, Tim, for coming through, for sharing your insight. I am truly inspired, and I wish your company. I see the brand taking over the world. It's going to be bigger and better. And may God just bless you abundantly. And thank you so much for coming through. I know you could be doing something else, but you are here with us today. And thank you for the bookshelf at the back there. I'm also aspiring to get my own bookshelf, so it's wonderful. But thank you so much for coming through. Thank you so much.
Thank you so much. Thanks for having me. I really appreciate it. Go well, and I hope this was useful.
Fantastic. Now, thank you so much to everybody for tuning in. As I said, please, probably I'll be loading the dinner tomorrow. So go and check out in terms of the YouTube channel, Gav Talks Property and Finances. Please subscribe. Tell your family, friends, everybody, tell them to subscribe as well. And please don't forget, if you need the book, hit me up so that you can be able to get yourself a copy. And yeah, and be on the lookout next week. As I said, we're doing a of the wealth protection, and because we need to talk about these things, comrades. You know, your COPs, accruals, hey, it's a problem. So please join us again, and Cesar and me will be back again on that show, and we can have amazing time. So thank you so much, Gavin Mkabela, signing out. See you on the flip side.